Okay, welcome back, everybody, to today's Market Explained. This is the show where we talk about the economy. We talk about what's going on in the world to help folks try to make sense of it. And we've been at this now for 9 years. This is, I think, our 225th episode. I'm Brian Castle, your host. I'm here with Chris Reardon, my co-host. And Chris, welcome to the podcast.
Thank you, Brian. Glad to be here. Glad to talk a little bit about the markets and what's going on.
And Chris is our FourStar Director of Development. He manages all the products and services at the firm. He's a Clevelander, loves his Indians, I still call him, Cleveland Indians. And he's got a young family and really great to work with you, Chris. So thanks for being here and thanks for being on the show today.
Thank you, Brian. Glad to be here.
And again, I'm Brian Castle. I'm the CEO and founder of FourStar Wealth in Chicago. I'm an advisor to insiders and corporate executives. I'm involved in the national and international scouting movement. I'm the husband of the amazing Tripty and father of two great sons, Quinn and Evan. So we're going to get going here, everybody, and we're going to start our day. So welcome to the podcast. Chris, you usually give us some sense of what's going on in the market since our last episode. And, now what are those relationships in the six major asset classes? What's up, what's down, what's working, and what's not?
Yeah, so I mean, it's a little bit of continuation of the same, but really it's two asset classes that have really continued to pull away from the pack. Number one is still domestic equities, and that gained 7 points since the last podcast. So it's continuing to gain. It's actually starting to approach now that 300 tally point area. So it's an interesting thing to watch. And number two is international equities, and that gained 5 points. It's at 267 in that number two position. So one and two continue to strengthen, they continue to gain. And that's overall really good. I mean, usually during a bull market, when we see a bull market, it is usually domestic and international equities, one, two leading the way. So from a market perspective, that is obviously a strong indicator that we are continuing to be in a bull market, at least currently. Commodities are in the number three position. It's at 224 and it's -4 since the last podcast. So that's another one where we continue to see that commodities deteriorate and move down. At one point, it was really moving back and forth, jousting back and forth with domestic equities and international equities, challenging for that one and two position. And we've really seen it kind of fall out. It is still by far the number three, but it has certainly distanced itself from that 1-2 position there. And then the bottom three we haven't seen too much of a change here. Cash is still in the fourth position. It's -3 since the last podcast. It's at 125 tally points. Currencies is in fifth at 104, and that's -4 tally points since the last podcast. And then last is still fixed income, and it's at 92 and actually unchanged since the last podcast. So not a whole lot from as far as shakeup, as far as what we're seeing, asset classes rising, if you will, out of, overtaking other ones. But like I said, I think overall it's a very bullish asset class that we're seeing right now with domestic and international leading the way.
Excellent. Well, good. So I'm seeing that your comments that commodities had been neck and neck, though. So international is kind of taking the lead in the second position and getting very close to leading over domestic equities. And we haven't seen that in a long time, Chris, have we?
No, we haven't. Yeah, it really up to I think this past week, international has really gained on it, but domestic this last week, I mean, it just outpaced it briefly. So, but yeah, I mean that has been what we've been seeing is international continuing to slowly close the gap there. And yeah, if we do see that, I mean that would be interesting. We've always kind of the U.S. markets have been strong for a large part of the last decade. Internationals really played second fiddle for most of it. That we were always wondering, are we going to see an international bull market? And maybe that's something that's coming down the pipeline. We really won't know until we really see that. It's certainly been one of the stronger asset classes this year, that's for sure.
Absolutely. Well, good. Well, then, we're also seeing fixed income sitting there in the last position. So fixed income meaning bonds, and that's, all kind corporate bonds, treasury bonds, municipal bonds. in the last position now for almost, what, 4 years now, Chris?
Yep. Yeah. I mean, it's definitely been, currencies and fixed income have really been, they've swapped here and there, but they've really been in the 5 and 6 position for a while now. Yeah. For the last 5, 6 years, I want to say. And, it's probably going to continue that way. It's just been a really risk on environment the last decade for the most part. We really haven't seen currencies or fixed income. Occasionally, we've seen cash move up. We haven't really seen that fixed income market take off. It's either been kind of a defensive cash market or an aggressive domestic market. There really hasn't been an in between.
There hasn't. And then, of course, cash is our cash, and then currencies is somebody else's cash, right? Outside of America. And those have kind of stayed in the four and five position. Although the other currencies are starting to act better than the dollar. And that's part of the whole trend with international too. So interesting. Chris, how about the sectors in general? Let's talk about them and let's see where we are in the general sectors, and we'll talk about the markets.
Yeah, I mean, it really interesting. I think this was an interesting shakeup that we saw since the last podcast. So year to date, the best performing sector now is actually utilities. And that actually jumped up 4 spots since the last podcast, and overtook technology. So utilities is up 22.04%, just barely taking over for technology, which is up 21.97%. So we saw this huge lunge from utilities, which really moved upwards. Communication was the biggest loser. That moved down. That was in first and moved all the way down to the third position, third best
Mhm.
sector.
Mhm.
It's at 20.28%. And then industrials is in fourth. It's at 17.77%. So, I think the biggest, obviously, news from the best performing sectors has really been utilities, and that big jump it had there. Going to the other side, the worst performing sectors, it's interesting. It's kind of the similar trend here, but healthcare, which has long been the worst performing sector, had a massive jump and moved out of the worst performer up 5 or 4 spots into the fifth place. But the worst performer now is consumer staples, and that's up 2.32% year to date, followed by real estate, which is only up 4.26% year to date. Then consumer discretionary, 4.42, and energy, which is up 6.53%. So healthcare, which, like I said, was the worst performer, is now up 7.12%. So we've really seen a massive bump up in healthcare off the bottom there in the last couple of weeks. And it kind of, launched it past those other four sectors
Mhm.
year to date.
It's interesting, and then healthcare is starting to move, and that's primarily drugs, right, Chris, and other things.
Yeah, we've seen that, the drug makers have certainly, I think, made a little bit of a splash with some of the announcements, some of their earnings.
Mhm.
So, I mean, and I think a lot of people have looked at that sector. It's obviously long been kind of battered. You get some of these value people look at that and say, all right, technology, is that overvalued? Where is their value right now? So sometimes you get a little bit of a surge into these undervalued sectors that have just been beat up year
Mhm.
to date. So we saw a little bit of that, some flows into healthcare that certainly gave it a big boost.
Well, and we talk sectors. These are the S&P 500 sectors. So the highest performing sector is utilities at 22.04, and then the worst is consumer staples at 2.32. So a 20-point gap between the worst and the best. But then the average so far is up 14, right? So our job is always to try to concentrate in the areas of strength and get out of the areas of weakness. We've been doing that pretty well this year. So that's how you beat the 14.7% benchmark. And that's up from 13.6 from our most recent show. And so that continues to grow. So we're in kind of a normal bull market in one sense, that market's just kind of melting up slowly, and we have like 5 up days, one down day. It's kind of a typical bull market. But one of the unusual things is this thing about utilities. Now, utilities have always been really conservative, and they've never been a leading sector. But this is all about energy, Chris, isn't it? This is about AI and data centers and all these new things.
Yeah, I mean, certainly. I mean, I think you've seen The need for energy, obviously, that's been talked about a lot, that AI, the consumption that's going to be
Mhm.
needed for the use of this AI. And we've seen a lot of headlines on it. Nuclear's, come into play a lot more. A lot of nuclear power plants are being either reactivated or they're trying to bring them back online with these big contracts. So there's certainly this, you think about supply and demand, the demand's there, and really the supply isn't necessarily there. I mean, I think they're trying to get nuclear online, but nuclear energy certainly takes a while to A, build more and also B, bring more online of the existing we have if it was, either retired or something like that. So right now we really just have to make do with a lot of gas energy, things like that, LNG, liquid natural gas. So, what that does is we have a limited supply, demand continues to heat up, and that's why we're seeing utilities run for the most part. So it is a really interesting narrative that a traditionally conservative asset class, we're really seeing actually, take almost an aggressive role in a high flying market like this.
Yes, and we've never seen a bull market led by utilities before. So this is quite unusual, but it's not because the market, that would signal the market's not strong because the utilities are in charge. But actually, their utilities right now are a growth sector because of all the need for energy.
Yeah,
So
exactly. It's kind of like the old narrative, if you're on the gold rush, if you're going to California, you don't want to be the prospector looking for gold. You want to be the guy selling shovels. So people
right.
instead of picking a prominent AI company, just pick the energy companies because they're going to have to get the energy from somewhere.
From somewhere. That's right. And we're seeing lots of really new innovation in energy production and changes. We see a lot of new companies coming out, really quite fascinating. There's always changes in the economy in every cycle, and this is a change we hadn't seen before. And we have never seen utilities in the leading sector in a bull market. So while it is a regular bull market in a lot of ways, in other ways is not, right?
Hmm.
So the leading index of the year, the major index is the Nasdaq. Now, a couple months ago, it was the Dow Jones Industrials and the Russell 1000, which are more dividend-oriented stocks. Those are now in the fourth and fifth position. And so we've seen a big sea change in the summer. The technology stocks that were weak most of the year are now strong again. So we're seeing the Oracles and we're seeing Palantir and Apple and all these other companies that are the Magnificent Seven, if you will. They're starting to run. And so NASDAQ, of course, is a big component of them. And it's up 3 points since our last show. So it's the biggest mover of all. S&P 500 is up 14.77 as of today, was up 13.6 at our last episode, up 1% roughly. The Russell 2000, that's an interesting one, Chris, because we're seeing small caps run. We're seeing small caps and international. And so small caps are running, and that's up 11.49. That's in the third position. And then, like I said, the dividend stocks, the Russell 1000 value is probably the best index for measuring that. People used to use the Dow Jones Industrials, but they had a lot of technology to it, so it's not as dividend oriented anymore. But those are both up 10.74 on the Russell 1000 value and 9.89 on the Dow Jones, and they're up just a wee bit since our last show. So all the action is really happening now in the technology and the small cap area. And so that's kind of what we're seeing. It looks like an interesting market. We just had one down day yesterday after 5 updates, and we're in the middle of a government shutdown now. I think we're what, day 7 or maybe day 8? And the market seems to be shrugging it off, Chris, doesn't it?
Yeah, I mean, we've definitely seen a little bit of pressure, certainly on, I think, travel stocks. Certain sectors have obviously bore a little more brunt of that. But yeah, I mean, I think overall, it certainly hasn't impacted it as much as in the past. The impact really has been more significant. So, yeah, and I think a lot of that tends to the government that we have now has already kind of the narrative there has already been for a sleeker, a smaller, a slimmer government. So, compared to a prototypical government that's maybe bloated, things like that. So you have that. We're already kind of went through that narrative once. And so I think that's why we're seeing a diminished narrative impact on the market, at least so far. I mean, if it continues a month, 2 month, or, then, I think all bets are off. But at least so far, we've seen pretty diminished impact to the market.
Yes. Well, one of the things that we're seeing now, Chris, is the big announcement news. So there's been all these technology announcements, and then of course the stocks run up big that day. Like Oracle got a big order from OpenAI, and the stock went up 30% one day, and that made Larry Ellison, the CEO and founder of Oracle, the wealthiest man in America over Elon Musk. I think that's come down a little bit from where it was, but still, so that was the big announcement the other day. We saw Advanced Micro Devices get a similar kind of an order, and the stock popped like 20%, right, Chris?
Yeah, I think so. OpenAI and AMD, they formed like a partnership, like a multi-billion-dollar partnership. And this is in AI data centers. OpenAI was committed to purchasing 6 gigawatts of the AMD's MI 450 chips, I believe. So I mean, that's really the interesting thing with that is AMD is kind of the direct rival, that I'd say the biggest competitor to NVIDIA. And NVIDIA has obviously been kind of the darling child, if you will, of the stock market for a while now, been a big driver of the stock market. So it's kind of overshadowed AMD, and the fact that OpenAI did the partnership with AMD, not NVIDIA, really shows that AMD is really making an effort to challenge NVIDIA and try to take back some of the market share. So really interesting. But I do think one interesting aspect that isn't talked about enough with that is, as you said, Brian, these deals are having massive impacts to the stock exchanges and the stocks themselves. I think Oracle on the day that was announced popped something like 40% at the high. And it's not a small cap company. This is a very large company in that, moving 40% in a single day is unheard of for the most part.
Mhm.
So
Yeah.
it really brings the perspective of you have this company, OpenAI, which is still a private company, having such material impact on the public markets. We can't see what OpenAI's financials look like. We don't have that look there. So, is there really is there confirmed ground behind some of these deals, or is a lot of it just kind of soft numbers? And we won't really see that or know until we get earnings from the Oracles, the AMDs, that we see that cash flow into there. We won't really know. So it puts kind of an interesting conundrum on the markets, I would say.
It does. Well, so we're seeing kind of normally orderly bull markets. Some little differences. There's always some differences, but and so we wonder why that's happening because the economy has been slowing down. Earnings have been generally good, but the economy's been slowing down. Employment's slowing down. Inflation has stayed uncomfortably high, higher than it should in both goods and services. So, Chris, give us an update on where we are in the economy. Is that slowing down or is it accelerating?
Yeah, most of the things are slowing down, but in certain indicators, it's slowing down less, I guess you would say. So
Yeah.
couple things I'll highlight real quick. Existing home sales decreased by 0.2% in August to a seasonally adjusted annual rate of 4 million units. So that's really interesting. The median home price conversely rose to 422,600 in August. That's up 2% from the year prior. And that's the highest price ever for the month of August. Not ever, I think the highest ever was back in June or July, but for the month of August, that's the highest median home price. So we still see, what this is really showing is we still see a stubbornly high-priced real estate market, especially personal real estate market out there, home prices. And we also see we're not seeing movement necessarily. I know the Federal Reserve has lowered interest rates. Most people, and I think the 30-year mortgage is the lowest it's been in about a year now. So, a lot of people expected to see maybe some people come back off the sidelines, but we really haven't seen that yet. We really haven't seen that kind of open up. So certainly a thing to watch, but I think the biggest thing people are really looking for is the labor market. We have seen signs of it rolling over. We talked about that a little bit on the last podcast, but U.S. private sector payrolls, so this is the ADP report, they lost 32,000 jobs in September. So that's a negative 32,000. The expectations were actually for a positive 45,000. So that's a big, obviously, gap there. So continue to see a softening labor market, which is obviously a bit of a concern there, and how that's going to impact future numbers as far as spending, things like that. But one interesting aspect, because we've seen this softening labor market now for a couple of months, and we really haven't seen a slowdown in GDP. And what that really shows is productivity picking up. So in Q3, labor productivity grew at about a 3.5% annualized rate, which is really interesting when you look at the previous decade. It's just been stagnant productivity. And actually, if you look back the last 2 years, productivity has been around 2%,
Hmm.
which is a pickup from about 1 to 1.5% the previous decade. So I think some people are saying, is this AI? Are we really seeing AI really boost productivity? Things like that. So, that's one potential for this market that I think is an X factor. We could see GDP, we could see economic growth with a softening labor market if we get increased productivity. So, certainly something to keep an eye on because it has been really a non-factor for the last decade, and now we're starting to see signs of it picking up. So, and then the last two things, the ISM Services Purchasing Managers Index fell to 50 from 52 in August. So we're right on that cusp. Obviously, below 50 is contraction, above 50 is growth. So the service sector continue to slow. And then the manufacturing, the ISM Manufacturing Index rose to 49.1 in September from 48.7 in August. So that is in contraction. It's been in contraction. The positive aspect there is it's getting closer to that 50 mark. So it's getting closer and closer to kind of breaking even, if you will, and hopefully hitting growth. So most of what we've seen is slowing, but as I said, in the manufacturing, it's slowing, but the rate at which it's slowing is decreasing, which is overall positive kind of reading.
Hmm. Yeah. So, so if the economy is kind of slowing, but certain parts of it are not, then we've got a strange situation. And usually when the economy is slowing, we're not at market highs, right?
Yeah, I mean, usually not. We're at a really interesting market right now where you have this narrative with the Fed and the lowering of
Hmm.
interest rates and stuff. So, usually when the market's really heating up right now, we're kind of in the opposite, right? We have the market heating up. Usually the Fed's either raising interest rates to try to kind of cool off the stock market, things like that. We're seeing an opposite. So it is a very unique market right now in that we have stock indexes hitting all-time highs, yet the Federal Reserve is now, I think, penciled in 3 interest rate cuts for this year. So inflation, although it is high, we're not seeing rampant inflation necessarily. We're not seeing 5-6% reads on inflation either. So
Hmm.
it's a really kind of convoluted. There's so many different factors right now feeding it. And it's almost like a Goldilocks market right now where you have this perfect combination of AI earnings. We haven't really seen any of that roll over yet. And then you also have the Federal Reserve with the expectation of rate cuts, and everything's just kind of helping keep that market pushed up.
I love the Goldilocks reference, Chris. We haven't heard that since the 90s. Not too hot, not too cold, and just right. And that's kind of what it seems like things are right now.
Exactly.
And
Yeah. And I think there's hope. There's hope right now that in the Fed, now that they're cutting rates, if we have a recession, do we completely miss a recession? Or if there is a recession, is it going to be extremely short-lived? So I think there's this hope that they're kind of threaded the needle,
Mhm.
that we're going to just kind of lift right back off in a low
Mhm.
interest rate environment. So
Yeah.
we'll see though.
Well, so we've got this Goldilocks market going on here. The economy's slowing a little bit, but not that much. They may lower rates, but they may not because inflation is coming back. They say they're going to lower rates, but if inflation's still here, maybe they don't move as quickly as they could. There was thought there was going to be a 50 basis point interest rate cut the other day. They only went 25 basis points. Maybe that's a signal that they're getting a little bit scared of igniting inflation, right? So we don't want that to come back. Then we would have a slowing economy and inflation. That's what they call stagflation. We wouldn't want that. But maybe if the markets are running on a normal fashion, maybe the markets are signaling that whatever the slowdown is, that it's not going to be a long-term thing, and it's going to be rather short-lived. And then the markets tend to be a discounting mechanism 6 to 9 months in advance. So maybe the market's signaling, hey, the economy is actually going to start to recover. We have seen lots of investments in America, and the tally on that, Chris, now is up to 17 trillion of new investments ready to be made in America, announced, or it should be made in the next couple of years. That's a massive amount of investment in plant and equipment. There are all these plants that used to employ folks in the manufacturing sector and other sectors that were basically closed when a lot of our manufacturing went overseas to Mexico, to China, other places with lower labor costs. But now with the tariffs, much of that's coming back to America. We're seeing some of those plants are opening now. They've announced plants that are being built. The largest chip plant in the world is being built north of Columbus, Ohio, by Intel. In addition, Taiwan Semiconductor has never really built out of Taiwan. Well, now they're building a big plant north of Phoenix, and we know anecdotally what's going on because we have a real estate developer who we've invested with in our alternative sector who's building a lot of the homes of all the people that are going to be moving into town to work at the Taiwan Semiconductor plant. So there's a lot going on there. So if you want to build in America, the tariff is in fact zero, right? So the tariffs only affect you if you are building and manufacturing outside of America. So that's why so much investment is coming back in here. So I think the market is assuming that this is going to work and that we're going to see all this employment coming back and business coming back to America.
Yeah, I mean, and I think if you pair that with the tightening that we've had on the immigration, things like that, I mean, what does that point to? That points to, even though we're seeing a soft labor market here, I mean, we're going to have a supply and demand issue a year from now, 2 years from now, because we're going to have all these jobs coming there. And, immigration, unless we open the floodgates, isn't going to be a huge flood. So we're going to have a lot of, hopefully a shortage of, we're not a shortage of workers, but we're going to have a strong labor market coming up, is what
Yeah,
I
it
think
should
the
be.
markets might be trying to predict.
Well, and the other thing that we're seeing, and again, we get some a view of this as we talk to different players in the economy. We're seeing the manufacturing coming back and new plants coming on. One of the folks that we've invested with is a group called Worth Capital, and Worth Capital is a consolidator of manufacturing businesses around the Midwest. So they're buying other businesses, and so we hear directly from the CEO, our friend Eric Borum, what's going on in that sector, and there's an awful lot. We basically let manufacturing be done somewhere else, and maybe certain sectors, whether it be, t-shirts and hats and things like that. Maybe we're never going to make those things again, but things that matter, chips and other industrial things, maybe we are going to make those again in America. And certainly the tariff regime has caused a lot of that change to bring some of that back. So we're seeing that anecdotally, talking to our friend Eric and the Worth Capital folks, and learning what's going on in that sector. So I think it's exciting times in America. I think people are bullish on America. We are bullish on America, and we think that markets are generally going to be pretty good here. So
Yeah, I mean, I think, we don't know what everything's going to bring, but I do think we're seeing a lot of bullish sentiment. There still is obviously some concerns. I mean, we've talked about debt, things like that the U.S. has to face. But I think from a job perspective, there's I think a brightness out there that potentially could happen. We'll see. It hasn't come to fruition yet.
yes,
The
well,
opportunity.
good. Well, so now, Chris, we've got, this is our story on the economy. Now, we are seeing some other things going on. We've run up massive amounts of debt in America in the last 25 years. I remember working with a nonpartisan group called the Concord Coalition. And back then, we were running around the cities, and I was working in Chicago with that famous debt clock that you see in Washington that keeps clicking, showing the debt, and the debt was only 5 trillion back then, and we thought that was really, really bad. It was too much. Well, now it's 37 trillion, right? And so we got a really big debt problem in America. We're getting to be one of the largest indebted countries in the world. Now, President Trump has said in the campaign that he would be eventually selling about 10 trillion worth of government assets and paying some debt down. Now, if he did that, that'd be really great. But I had a conversation with the U.S. Majority Whip, Tom Emmer, who was just on TV here a second ago, about 2 weeks ago, and he said they're probably going to wait until the second part of Trump's term to do the debt pay down because of the elections and things coming up. But eventually, I think they're going to do what he said, and they're going to reduce the debt. So we've added a lot of debt in the short run we shouldn't have. But Chris, what that's creating, of course, is all the anti-debt sectors like precious metals, Bitcoin, all that's running, isn't it?
Yeah, I mean, gold just as of yesterday hit a record $4,000 a troy ounce. That's the first time it's ever hit that. So we continue to see gold. Bitcoin has obviously been there, and that's, mostly moved upwards, as well, has a little extra volatility to it. And we've seen silver move much higher as well. So we continue to see, I think you have that debt. That's obviously an issue. You have obviously the geopolitical issues and everything going on within the world right now as well. And you're just seeing a loosening cycle right now. A lot of the governments around the world are lowering interest rates. So
Yes.
even though we're lowering interest rates, the dollar's weakening, a lot of other governments as well. So really what that does is we're seeing a global demand right now for gold that's just pushing that price higher and higher.
Mhm. Yeah, it has. So gold has been running, silver's been running as well,
Yep,
and
silver's been another one.
palladium, other commodities, and then Bitcoin. Now, Bitcoin, was back what nine it was $4,000 an ounce about maybe 5 years ago, and now it's 100,000 somewhere around there.
Yeah, or you mean a coin? Yeah, it's about I think it's 115,000 ballpark.
115, right?
But yeah, it keeps kind of moving around. It's obviously a volatile asset, but yeah, I mean, Bitcoin continues to be really interesting. I mean, people have even said that they could see it going to, two, 300,000 Bitcoin. So, but once again, extremely volatile asset class. We could see it go to 60,000 before it goes to, 200, 300,000. It's certainly done that before. So I mean, gold I think has a little bit more behind it as far as the resource, the known commodity, the safety aspect of it. Whereas Bitcoin's kind of a or just a volatile hedge. It is seen
Mhm.
kind of as a outside the system play, which is why it gets kind of played as almost a gold, but certainly carries with it an extra amount of volatility for sure.
Right. And so now we're seeing this kind of a market. So now we've seen a strong bull market, but because we're seeing these changes, we're seeing international stocks doing better because the dollar's been weaker because of our debt. We're seeing commodities run, primarily precious metals. Oil was strong. It's faded a little bit. But now, if we're seeing commodities in general and international working, this reminds me, Chris, of a market that happened in the mid 2000s. So after the tech crash of 2000 to 2002, then the stock market did recover, but it only went up about 6% a year on average for about 5 years. And what was working then was international stocks and commodities. And so we're seeing that happen now. So that we're in the beginning phases, and we have not seen an international rally for many, many years. But it's been about 17 years since we've seen an international rally, but we're seeing one now. It's been sustained about 9 months now. And international stocks are the best performing of the year. If you look at all the major asset classes against each other, international and commodities, and then the US stock market is behind that. Although they may be in the short run in the top ranking as far as what's moving right now, but as far as overall performance, international has been better. So, we'll see if it's that kind of market, but it is possible to have a market where the US markets are not the leading market. We've been the leading market for so long, and we could see a couple, years there where international stocks that got so cheap that are starting to run, and then commodities running as well, Chris. So we'll see if it plays out.
Yeah, we'll see. I mean, I think you made a good point with the tariffs and everything, Brian, that that was a unknown factor. We didn't have that kind of in that time period you said. So maybe we see the short run here, and maybe then it kind of topples all the way back to the US if that plan, works out. So there's a lot of factors there, but I do think we're seeing some good strength in the short term, at least short to midterm with international, especially.
Yes. Well, that's it, I think, for the economy, Chris. Let's turn to our segment of the show we call What We See Out There. And we already talked a little bit about the partnership of AI data centers, but I know there's a couple other things you wanted to cover.
Yeah. Yeah. I mean, I think a couple interesting things out there. The video game giant Electronic Arts or EA Sports, obviously they make the Madden football games. They're nearing a $50 billion deal to go private, which, if they do kind of accomplish, would be the largest leverage buyout ever. That'll be really interesting to see. Obviously, you have a public company going private again. And that's been a trend we've seen more and more, as a lot of public companies just don't like the scrutiny of the public markets and the volatility there. So something to keep an eye on. And then Airbus, the Airbus A320 blew past Boeing 737 to become the most delivered jet in history. So obviously Boeing has had struggles, its share of struggles the last 5 years, 5 years, and I would say even beyond a little bit. I mean, we're seeing Airbus take advantage of that. And obviously, we've seen, I mean, I've personally flown on more and more Airbuses as of late as well, as it's just become more prevalent, even in the US. Certainly an interesting thing there. We'll see if Boeing can kind of recover that. I know they're obviously trying to, but right now Airbus seems to have the leg up for sure.
They do. Okay, and then what I see out there basically, one of the interesting thing we're seeing is Spain, which had been a country that hadn't done much for a long time. They had 25% unemployment when everyone else was in a bull market and a strong economy. Well, they become a leading economy now. They were considered they were a basket case for a long time, heavy bureaucracy, but now they've got over 3% growth, and the 1% growth is what's going on in the general Eurozone. So that uh, international stock rally I mentioned doesn't necessarily mean that the economy is doing better. It just means the stocks might be so cheap, and people are concerned about our dollar. But anyway, Spain's doing well. Tourism's recovered. Employment reforms have made companies more stable, allowing up to 600,000 immigrants to come in to fill jobs, and they've got jobs in that country. So it's going well again in Spain, which is good news because we like Spain. It's a nice country. Um, and I think the other thing that I wanted to mention is we're seeing a return of the meme stocks. Everybody remembers back in like 2021, Roaring Kitty was running the GameStop stock, and then Kohl's and some other companies. We're seeing some of that activity again, Chris, and that's kind of a sign of a general bull market. So I think that's all we have for this today. The question I guess you might have, everybody, is what are we doing about all these things? Are we invested? Are we not invested? Well, our models are skewed toward the sectors that are doing better, which we covered earlier, and the sectors that are working, but we're fully invested right now. So even though there's always some kind of concern, we just follow what the trends tell us, and the trends tell us to be fully invested, and we're being rewarded for that. So we're ahead of benchmarks, doing well. And until we see any other evidence to the opposite, we will keep that posture, right? And if things were to get bad, we have what we call the four-star protection plan, which we've talked about on this show before as well, where we raise cash and partially get out of the market. We've only gone to full maximum cash 8 times in 31 years. We did it in April because during the Trump Liberation Day, the markets were very rough. We were getting signals back then, but that really did help our clients get lower volatility and better returns by not being fully invested when the markets are selling off. But suffice it to say, we are fully invested right now, Chris, and we're going for it.
Yeah, I mean, it seems like the market wants to move up, so we're staying with that until we see a contrary, we see a slowdown or something. So
Yeah.
right now we're running with it, and if we see anything, we'll start to take defensive measures.
Great. And also, folks, I just wanted to highlight and point out these podcasts are available on Apple iTunes, wherever you found it today, Spotify. So please send that out to your friends. We're developing some new podcasts in the firm as well. So we'll be developing a new site section of our site in the fourstarwealth.com that has our podcast interviews link. Also, the blog posts there in the Leadership Matrix, Counting Macros and Sustainable Retirement Income, the blogs that we have on the screen. There's a piece we did put out in late September about power and the issues about the utilities are in the lead. Power is doing really well, but is it ever possible for power generation to be really green? So it kind of explores that issue, like how do we generate power and not defile our environment, right? That's a big issue for a lot of people. So there's an article that talks all about the issues about that. So that's it, Chris. I think that's it for us, huh?
Yeah, I think that covers it for beginning of October now.
Okay, welcome to October, everybody. Baseball playoffs are there. The Cubs are going to do or die today. We'll see how it all goes, and wish everybody all the best. We'll sign off for today. So this is FourStar Wealth signing off until our next episode of today's Market Explained. Thank you very much. Over and out. Bye-bye, everybody.